All right, everyone. Thanks for joining. Thanks for hopping on the call. Really excited to talk through some underwriting. I know it's an exciting subject, but it's an important one. So kind of get started here. General overview. I'm going to kind of go through high level what syndication is in the beginning, and then after that, I'm going to dive pretty deep into the underwriting component of analyzing a syndicated deal. So we'll kind of get into some details. I got quite a bit of information here on these slides. Some of it might go over some people's heads, but that's okay. I think as long as you're introduced to these subjects, that's the important part. So I tried to create it in a way where it was simple enough for people that might not be fully familiar with this, but also complex enough for those that are really trying to learn everything about syndicating underwriting. Okay, so let's get started. So first off, here's a little bit of my story of how I've gotten to where I am in this real estate stuff. So kind of growing up, I saw the opportunities that real estate provided through my dad. So my dad owned two duplexes, bought two duplexes in his 30s or so. And both my parents, worked very blue collar jobs. My dad drove a cement truck. My mom was a teacher. But seeing what simply owning, having cash flow coming in from 4 units, what that could do for your life, and the luxuries it can buy you just simply off 4 units, it opened up my eyes growing up. So I knew my first thing. I get done with college in 2016, and I kind of just knew, okay, I just got to buy a duplex. That's all it really started with, was let me save up some money, buy a duplex. So that's what I did. I saved up some money for a year or two, went out, bought a duplex, did the old house hack model where I'm living on one side, renting out the other. And that's kind of how I really got into it first. Did some simple education before that, but didn't really know much about it. Get into it, and within the first few months, it's right away, everything starts clicking. And I realize, how awesome real estate investing is, and how the power of cash flow and all the benefits you can see. I mean, I'm living in this duplex, living for free, and I'm cash flowing on top of that. So instantly I was like, all right, I got to figure out a way to really blow this up. The whole 4-unit thing went out the door. It was, okay, how can I create this into something much larger? So I kind of started, I think, where everyone starts. Started listening to podcasts, and a lot of them talk about the flipping and the wholesaling. So I tried that. I was out putting bandit signs around town, sending letters out, doing everything I could. Didn't really have much luck with it. And then during that process, I came across this concept of syndication. And that really caught my attention, because I saw it as a way to actually build a business around. It's something I can create into a full-time gig. And that's where I spent after that. I said, okay, this is what I'm going to do, skip everything else. This is what I'm going to focus on. So really, the obvious thing was, I didn't have the experience to go out and, buy a large apartment complex on my own. I didn't have the net worth. I didn't have the liquidity. I didn't have the experience to get the loan. None of that. So my strategy was, I'm going to learn. There's a lot that goes into syndicating a deal. Let me learn one piece of it, and then I'll go out and I'll find partners that lack that piece, but can kind of do everything else that I need to be able to do these deals. So that's what I did. I chose underwriting. I was naturally kind of from an analytical background, so it made sense. So I spent about 6 months just, pulling information together from podcasts, books, different forms, everything I could to learn underwriting. And I was just practicing, becoming familiar with it. And after that, 6 months later or so, I go out and start networking, and I start looking for partners. Connect with one partner that had another friend with more experience. This other guy already had a portfolio of properties. So we create a partnership, and we go out, a few months after that, we buy an 89-unit apartment complex. So really the journey from buying a duplex to closing an 89-unit deal is about a year-long journey. I mean, it was a lot of work, definitely, some luck in there. But that just shows how quick you can scale if you get into something like this, compared to where I could have gone out and maybe just bought, one more duplex the next year. So kind of going into the next year, we go to 2020, we end up syndicating 4 more deals. During that whole time, I'm working a full-time corporate job in IT. So doing both becomes a lot. 2021, I'm able to quit my job and become a full-time real estate investor. So we went and then we get our portfolio to $15 million assets under management is what we're at right now. So it was, about a 2 to 3 year journey of getting into it and being able to quit my job and be a full-time real estate investor. Okay, so here's kind of some, experience of where also of what we've kind of done. So our company, Smart Asset Capital, one of the principals there, along with my two partners, we're at about 15 million assets under management right now, and that comprises several different asset classes. Like I said, my main role in the partnership is a lot of underwriting, finding deals. Now I'm kind of involved in all components of the business, but I'd say it's still where most of my time is spent. Over the years, I mean, I've underwritten, billions of dollars worth of deals. I'm looking at deals every day. I enjoy doing it, and it's useful to be able to have the knowledge of it. And then during that time, I also created my own model for analyzing deals, which has been great. Okay, so here's kind of a step back. What is syndication? For those that aren't familiar with exactly what it is. So really, in its most basic definition, I'm going to kind of read this off right here. A strategic way for investors to pool their funds together to buy properties much larger than they could afford or manage on their own. It's really, at the end of the day, it's just creating partnerships. There's a little bit more to it than that, but that's the basic definition of it. Here's kind of an example that might kind of illustrate it better of what it might look like. So let's say two people, they come across a great deal. It's $4 million, and they decide they want to buy it. So these two people are going to be called the sponsors of the deal, or often referred to as general partners, GPs for short. So the sponsors, they don't have that, they have to put down $1 million to buy this deal. They don't have the $1 million to down payment. So they decide, okay, let's bring in some other partners that want to invest in real estate, and we can just fund, the down payment through them. So they go out, find investors. Those investors are called limited partners, or LPs. So those sponsors, at the end of the day, they might find 10 to 20 different investors to come up with that $1 million. They get it in the account. They end up buying the deal. And really the final outcome is the limited partners are enjoying, the benefits of passive real estate. They're not involved with any of the decisions. They don't get tenant calls. They're involved with nothing. They don't sign on the loan. They're just getting a passive return. While the GPs, they're doing all the work, finding the deal, getting the debt on the deal, managing the deal, asset management, investor relations, they're doing everything. But they get the equity upside for doing the work. And I'll kind of explain next on what that might look like. So again, highlighting, the LP responsibilities, really all they're doing, they write a check, sit back, enjoy the cash flow, get the tax benefits, and they wait for, a 5 to 10 year exit. Really, when you make your big money is when you either sell or refinance. The GP responsibilities. So that's those two people that put the deal together. They're going to find the deal. They're going to put their names on the loan to sign for the debt. They're going to have to go out, raise all the investor money. There's asset management. They have to deal with investors if something goes wrong, explaining what's going on at the property. They have to manage the exit of the property. So there's a lot of work that goes into it. It's not a real simple process. There's quite a bit that goes into it. Okay, so how do the general partners get paid for all the work? You might kind of be asking yourself based on all this work that I said you have to do one of these deals. So there's a lot of different fees. You'll see people get really creative with this. There's a lot of different fees people charge. The three most basic ones are going to be an acquisition fee, an asset management fee, and the equity split. So acquisition fee, that's generally, again, these terms vary. This is just kind of what you generally see in the industry. 2% of the purchase price. So 2% of the purchase price, the general partners get that at closing. Asset management fee. So 2% of the top line rental income that gets paid yearly to the general partners. And then the equity split, that's really the big part of these deals. Is a common one is there's different ways to structure. There's a lot of, you can get really complicated and keep it really simple. We're going to keep it simple in this example. A basic structure is just a 70-30 split. So every single dollar that comes in profit and cash flow, whether that's through, monthly cash flow, or if it's through a refinance or through a sale, 70% of that is going to go to limited partners. 30% is going to go to general partners. So, for example, if you're the general partner and you have 30% equity in the deal, and you sell a property for $1 million more on the exit, you're getting $300K. So that's really where the acquisition fee, the asset management fee, it's nice. They're nice supplemental income sources, but the equity on the exit and syndication is where you make the big money as a GP. Okay, so here kind of goes through the process of syndication and what syndicating a deal might look like in its most basic form. So first off, obviously there's finding a deal that is tough right now. Obviously, anyone that's done anything in real estate knows it's tough to find deals right now. So you're out networking with brokers, doing everything you can to find deals. Really, I'd say expect to analyze 100 deals to find one you want to buy. Could even be more than that. You have to look at a lot of deals. So you're gonna, you find your deal, then you're gonna negotiate the LOI or the contract once you get to that point. So you get the deal under contract. Now it's time to go raise all the money from your limited partners. So you're gonna put together an investment summary deck. You're gonna send that out to all the investors you have in your network. You might even host a webinar and kind of talk through the deal. Meanwhile, you're gonna have an attorney preparing, 300 pages of legal documents. It's not quite that much, but it's a lot of legal documents. Once an investor commits, they're going to come in, they're going to sign all the documents that spell everything out. Then they're going to send their investment to a designated bank account you set up just for this deal. And kind of during that process as well, during your due diligence, you're going to be creating banking relationships. You're going to send out this deal to all your bankers that you have in your network. And then they're going to offer you different terms, and you kind of have to decide which bank's best to work with based on the terms they're offering. And then once you decide which bank you want to go with, you will commit to using them. One thing here too I have in there is banks are, it's not as they're going to look at the deal first and foremost based on how the deal performs. That's the most important part. But if you don't have any experience, you don't have a high net worth, you don't have any, large amounts of money sitting in the bank, most likely, unless you have a really good local bank relationship, they're not going to approve you for a loan. That's where a strategic partner, someone that might already have the experience or might already have the net worth, bringing them into the deal on the general partner side helps a ton. And that's something, if you're just getting started and getting into this, that's something you're going to have to do. If you already have a whole bunch of experience and, kind of check all those boxes, then you might not have to do that. Then lastly, the asset management. This is something I think a lot of people forget about, because for these bigger properties, generally you're going to have a property manager. Property management's great. They're going to handle, day-to-day tasks, tenants calling, collecting rent, maintenance, all that stuff. But asset management is managing the property manager. So during your investment summary, you create a business plan and you create a pro forma. And this is what you tell investors you're going to hit for returns. Your job as the asset manager is to make sure everything comes through true you're telling investors. So you can't just sit back and inspect the property manager do everything. You are in charge of making sure everything goes right and overseeing the property manager. So there's a lot that goes into asset management, something that often gets overlooked in a lot of the different education you're going to see out there. Okay, so breaking into syndication. So this is, like I said, my thing was I learned how to underwrite, and I went out and partnered with other people that were stronger in some of these other components. But maybe, you're watching this and say, I'm not an analytical person, or I don't see myself learning how to analyze deals. I, am better at other things. Maybe you're strong in sales or something like that. These are kind of the main roles I've seen in syndication. There's the capital raiser, if you have a whole bunch of connections with, family money, or, a lot of connections with people with money, maybe that's your way to get into this. Maybe you have a whole bunch of relationships where you're just going to really get out and network and find deals. And that's a good way to get into it, and bring to another partner. Like I said, the underwriting, then there's the asset managing. Maybe you have a bunch of experience managing properties because you worked for a big property management company. There's different things. Maybe you have the net worth and the liquidity already, and you can just sign on the loan and partner with someone and get into a deal that way. There's a lot of different ways to kind of break into it. Again, for me, it was just the underwriting made the most sense. It's something I kind of already understood and was able to get in that way. So like I said, again, partnering with others that lack your strong skill is a really good way to do it. Okay, so after that, now we're going to go into the kind of the meat of it, and this is the details on how to underwrite a deal. So basic underwrite is a term you're going to hear a lot. It's kind of a fancy word for analysis. just the process of analyzing a deal. There's two documents to begin underwriting. There's really two documents. If you're trying to underwrite a deal, there's two documents you're going to need to start the process. That is the trailing 12-month financials or profit and loss statement. That's often called the T12. And then there's the rent roll, which is going to list out the, all the tenants, what they're paying in rent, when their lease expires, everything like that. So those, you're gonna get those documents from the broker, or if you're dealing directly with the seller, they should be able to provide those documents in most cases. But that's the data you need to accurately analyze a deal. So, okay, so we're gonna get in here. So as you can see, there's screenshots. These screenshots are kind of based off of the analyzer I built. So you'll see the formatting is pretty consistent. And I kind of put together a sample deal underwriting. So we're just gonna go through analyzing this deal, and I'll point stuff out along the way. So first off, you're gonna pull up your T12. That's gonna have all, the profit and loss statement. And you're gonna start inputting that stuff into your analyzer. You're gonna see each T12 is different. It's not like they're all the same. They're gonna categorize expenses in a different way. So you're pulling off all the numbers in there, putting it into your spreadsheet, making sure at the end of the day, just that bottom line number matches. It's not super important how you categorize everything. It is, but as long as the most important part, as long as the numbers match the bottom. A few terms you're going to see. So gross potential rent, that is the income. If the property is 100% occupied, how much money does this property stand to bring in? That's gross potential rent. Effective rental income, that's going to be after your vacancy and after bad debt. Bad debt's another word for delinquency, tenants that aren't paying rents. That's your effective rental income. Net operating income, NOI, often referred to, huge term you're going to hear, and that's what the value of these properties are based off of. That's going to be your total net income minus total expenses. That gives you the net operating income, and that's what the value of the property is determined after on these larger properties. So you're gonna input everything into your analyzer from the T12, make sure everything matches. Next, and I'm kind of just going through the process of how it is built on mine. You're gonna input one thing, the taxes. Almost always when you buy a property, your taxes are gonna go up after you buy it. They're gonna reassess it based off of your purchase price in most scenarios. So, in 99% of scenarios people are selling, they are selling for a higher price than they bought it for. So expect your taxes to go up. So I have my own little way of analyzing that here by, looking up what mill rate is in your local market that you're buying in, to determine at what rate they're going to go up to. You can even, during due diligence, what we do is we even call the tax assessor and get his opinion on where he thinks taxes are going to go to. But for the initial stages, just using a blanket rate is fine. Reserves. So this is something some people forget about, but something you need to do. If you're buying a property like this, especially bringing on investor money, you want reserves sitting in the bank account. You don't want to go in and just have no money in the bank account when you close this deal. You got to have reserves for, rehabs, or maybe there's something goes wrong when the water heater goes out, you need $8,000 to fix it. You don't want to be just depending on cash flow to cover expenses. Something's going to go wrong. Nothing ever is going to go perfect. You want to have money sitting in that bank account at closing to cover expenses that come up out of nowhere. I generally look at 6 months, even up to 12 months on some deals of every single. So I take all the expenses that property is going to incur and take 6 months of worth of expenses, or even 12 months. You can kind of find a sweet spot in there depending on the deal. And that's what we'll put in our bank account at closing to have a buffer there. Rehab budget, if you're fixing up units and flipping them and increasing rents, you're going to input a rehab budget. On the front end, you're probably not going to really know exactly what it's going to cost to rehab all the units. So just use your best guess at where you think that's going to land. And then if you do end up getting the deal under contract during your inspection, you dial that number in more closely. Okay, so normalizing expenses. So the word normalizing, for those that don't know, it's really it's making an educated assumption on what you think you're going to run the property at. A lot of times, and this is really where your chance to be conservative is. A lot of times you're going to see some pretty aggressive numbers used on an offering memorandum from a broker, especially if it's from a broker. a lot of times you're not being 100% factual on the expenses. So you just want to make sure you're not just using that, and you're kind of doing your own analysis and research to determine what you think you're going to manage this property at. Almost in every scenario, you're going to be managing this property a little bit higher than what the previous ownership was, just because the year before they sell these deals, they trim down expenses as much as possible. They'll cut corners. They might not include everything they want, because the property value is determined off the NOI. So they're going to do everything they can to not have, expenses come through. So you got to be ready for some of those expenses that might not have been accounted for. So it's kind of some tips here. So look at the vacancy factor. If they're using a 3 or 4% vacancy rate in their model, you might want to bump that up a little bit. You might want to put it to 7%. Again, just be conservative on everything and assume, some stuff's going to go wrong. Another thing is the bad debt. A lot of times, almost always, you're not going to see a line item in a T12 that shows bad debt or delinquency, rent that wasn't collected. So, and especially right now with the eviction moratorium, I know it's kind of coming to an end, but before, if you're looking at a 100-unit apartment complex, do you really think all 100 units are paying their rent each month? No, there's gonna be at least one tenant each month that doesn't pay their rent or goes delinquent. So throw in, 2%, 3% for that. Then you're going to kind of look through expenses and see if anything sticks out that appears low. Maybe they have, they don't have any costs in there for landscaping. You don't see anything. There's a huge lawn in front of the building, but there's no expenses entered in there for landscaping. Maybe they're just doing, it's a smaller time owner and they go out there on Saturdays and they mow it themselves. You're likely not going to be doing that. So you got to enter that expense in there. Stuff like that. You just really got to comb through every single expense and, get these numbers in the best places possible. Replacement reserves, we kind of spoke about this, but you're also going to want to be depositing money each year into that reserve account. So a general rule of thumb I use is $250 per unit per year. And it's just going to go into your reserve bank account, and just sit there, and hopefully you never have to use it. But if something does go wrong and you need 20 grand to replace a roof, you pull it from there. You're not having to come out of pocket or do a capital call and go back to investors to raise more money. You kind of have that nest egg sitting there. So the expense ratio, that's something always to look at. Depending on the property type, generally a class A property, the operating expense might be, 45 to 50%. And it goes up. Class C property, you're likely going to be closer to a 60% expense ratio. If you look at the expense ratio on the T12 and you see it's, in the 40% range, you're probably missing something, and you probably got to add some more expenses in them that aren't in there. So generally at least have that expense ratio at 50%, more likely have it, in the mid 50% range. And also we'll do, if any questions come up specifically as I'm going through this, feel free to type in the chat, the Q&A box. Otherwise at the end, we'll go through questions. Okay. So debt service, fancy word for mortgage. This, you're gonna enter that in next. So, during the process beforehand, before you start, looking at deals, it's good to start building some relationships with banks. The bank's the biggest partner in your deal. They're going to finance, they're going to leverage, 70%, 75% of the deal. They're your biggest partner in the deal. So start building those relationships, first, or at least during the process. So when you're entering in the assumptions, you're going to go in there. Let's say you think you can get your loan. This loan is going to pan out to a 4% interest rate. Again, you're hearing me say conservative a lot because that's the most important part about underwriting. What I do is I assume at least 25 basis points higher than what I think we're going to get. So if I think 4% seems about right, I think we'll get 4% of this deal. I'm using 4.25% in my underwriting. Just, you never know. If you have a deal under contract, you're going to close 3 months from now and they decide to, up the interest rates in that meantime. And you'd rather have that buffer in there than, all of a sudden your numbers don't work anymore. You're under contract because financing went up. That's a huge part right there. Make sure you bump up at least 25 basis points. So this is kind of the end of entering in all of the P&L numbers. So it's going to give you a quick snapshot at kind of where we land with some of these high level return metrics. So a cap rate, for those that aren't familiar, a cap rate is when you take the net operating income divided by the purchase price. That's going to give you a cap rate. So cap rate's a term you're probably going to, along with NOI, those two terms get thrown out all the time. A cap rate is really, for me, it's used as kind of a quick way to understand where the pricing of the deal falls. You're gonna hear brokers use cap rate a lot. You know, what cap rate are you looking for? It's good to understand kind of where you're buying at relative to what that sort of deal is trading at in the market, to know if you're, overpaying or getting a good deal. But to really do a deep analysis on returns, to me, cap rate doesn't mean much. If it's a value add deal and you're upping rents, maybe you could buy it at a 5.5 cap because there's a whole bunch of upside. So it's good to understand how cap rates work, and know kind of industry average for different asset classes. But don't let it be kind of the end all be all when you see it's a 6 cap and it's like, okay, the numbers don't work automatically. Cash on cash return, that's another real popular metric. That's just going to be the cash flow divided by the total amount of equity put into the deal. Debt coverage ratio, or DCR, that is the net operating income divided by your debt service payment, or mortgage payment, another word for it. So the debt coverage ratio is something mostly the banks are going to look at. That's like their favorite number to look at. They want to see that number at least 1.25. They want to see there's a healthy buffer in there to cover the mortgage. That's because at the end of the day, the most the bank cares about is whether they're going to receive their mortgage payment each month. So 1.25, generally what they're going to look for in that. You want to make sure your deal hits at least that number on the low end. Okay, next is going to be the equity summary. So this is where you're going to enter in your syndication split if you're syndicating the deal. So like I said, acquisition fee, a common one, is 2% of the purchase price. So we're going to use 2%. We're going to use, like I said, that 70-30 model. That's going to be the equity split. So 70% is going to limited partners, 30% is going to the general partner group. There's going to be an asset management fee in there of the 2%, like we spoke about. I did, in this example, I included a preferred return. I won't go too deep on what a preferred return is, but that's pretty common in some of these deals, especially getting the larger deals. And essentially what it is at a high level is preferred return is going to be, if it's 8%, the limited partner is going to get an 8% return on their money each year. After you hit an 8% return, then the split goes to 70-30. You don't participate in that 30% upside as the GP until an 8% preferred return is hit. So that's a preferred return. You can structure it with that or not. Like I said, you can get really creative on how you structure these deals. A capital transaction fee, we've never done any of those, but that's common too, for taking some upside on the refinance or sale. So yeah, then this is going to give you a quick snapshot of where we lie on how much money we need to put into the deal and what all the costs are going to be. Closing costs. So there's going to be some more, compared to buying a duplex, there's going to be some more line items on a syndicated deal when it comes to closing costs. So you're going to have all your standard stuff, like an inspection, an appraisal, all that standard stuff that comes to any deal. But there's stuff like legal fees. You're gonna have the amount of documents you're drafting for these deals is probably around 100 pages. Is about where it usually ends up. There's 3 different documents the attorneys put together. Find yourself a good attorney to work with that knows about these structures. They'll guide you through the process. You don't need to understand how the whole legal side of it really functions. You want to know high level of all the different rules to follow, and I won't get too into that, but a good attorney will be able to set you up with getting these documents drafted. Those can cost anywhere from if you have a simple deal, might cost you $5K. I've seen all the way up to over $15K on some of the more complicated transactions. So you want to budget that. You might play around with some of these numbers and lower some of them if you can get some of this for cheaper. But closing costs are going to be higher on deals like these. Okay, the exit strategy. So like I said, how you structure these deals on the exit is a big part of it. So you want to determine what your exit strategy is. So a lot of that depends on the type of loan you're getting. If you're going to get, a 5-year loan or a 10-year loan, that's going to change how you structure it. Sometimes, we structure a lot of our deals where we're going to do a cash out refinance at year 5 and return, plan is to return all the initial equity. And then we're going to sell at year 10. That's a common structure. Maybe you decide, hey, I'm just going to hold it for 8 years. And I'm going to sell at year 8, no refinance. I'm going to get a 10-year loan, low prepayment penalty, so I can sell at year 8. So I think that's how I structured this one here, is we're going to do a sale at year 8. Okay, here's a really important part that a lot of people overlook. When you're doing your assumptions, you're going to input an assumption of what cap rate you're going to sell this property at. So like I said, cap rate, NOI, that's how you determine the value of a property. So when you're doing this scenario, you're going to look at, okay, what cap rate do I think I'm going to sell this property at? It's 8 years from now. No one knows where the market's going to be 8 years from now. You could be the smartest person out there. No one knows where cap rates are going to be 8 years from now. So, there's maybe you decide to do your own crazy analysis to try to figure out where the market's going to be at 8 years from now. But for me, I just like to be conservative, and I'm just going to assume cap rates are going to go up. So if they go up, that means, purchase price, it goes down, in correlation. So what I generally do is I do at least 50 basis points higher. So if I'm buying a deal at a 7 cap, I'm going to assume when I sell it, I'm selling at a 7.5 cap. Sometimes even higher. I might even go 100 basis points higher for, depending on the deal. But rule of thumb, always go higher on the exit cap rate. You want to be, because that's the biggest thing that'll sway the numbers, is your exit cap. Because like I said, that's really where you make the big money on these deals, is the sale. So that'll sway your numbers a ton. Be conservative on the exit cap. The last thing you want to do is assume a lower exit cap, and then 8 years from now, the market's in a bad place and you sell for a way higher exit cap. The numbers all of a sudden are horrible. So that's a common thing. A lot of people out there right now, a lot of syndicators, I've seen it firsthand, where they're assuming an exit cap rate lower than what they're buying it for. And it's really easy to make a shitty deal look good by throwing in a lower cap rate than what you're buying it for. It'll make the numbers look great just by one simple number in the spreadsheet. So that's a very important part. Be conservative there. All right, profit and loss statements. So this is really where you get the full picture of what's going on in this deal. It's going to kind of show you the whole, in this example, it's an 8-year horizon. It's going to show you what it looks like. So this is where, for me, if you're going to do any sort of value add strategy, this is where I enter it. Say you determine, all right, I can increase the rents to X, because they're below market. You do your rent analysis and determine you can get them up to this certain level. So you decide, okay, I'm going to bump rents up in year 2 and year 3 by 6%. You're into that in here. There's a way in my spreadsheet, or kind of just automatically inputs it once you enter the amounts. But what you want to make sure you do is, say you determine, okay, I can increase rents 10%. That's where I can get them so they're at market. You don't want to go in and assume in year 1 that you're just going to go in and jack everyone's rents up 10% and everything's going to go smooth in year 1 and you're good. What you want to do is, again, being conservative, spread that increase out over maybe 2 to 3 year horizon, where you're going to slowly increase rents. You're not just going to do it really quick. You're going to allow for some, turnover and stuff like that, to increase the rents. Also, what I do proportionately is, if I'm going to be increasing rents by 10% in year 2, I'm going to increase expenses by 10% in year 2 also. Because, it's pretty obvious. If you're going in and upping everyone's rents, people are going to move out, right? And again, same thing with vacancy. If I'm upping rents, I'm going to increase the vacancy. If you go in and tell someone, your rent's going up $300, per month this year, there's a good chance they move out. And if they move out, that's more vacancy on your P&L, and that's more unit turn costs on your P&L. So you want to make sure, what I do is I just line the numbers up. If I'm increasing rents, I'm going to increase my expenses, and I'm going to bump up my vacancy rate as well. That way you're not, everything could go right and your expenses don't go up and your vacancy doesn't dip down at all. But you just want to make sure you're kind of building a buffer there. Okay, so here's some, again, value add. It's another term that you're going to hear a lot, and that's really what value add is just increasing the net operating income, the NOI. Again, that's where the value of a property is determined off of, is the NOI. So value add is just doing anything you can, anything possible to increase the NOI. So there's literally hundreds of ways to increase NOI. Not going to go through all of them. I think there's really a book called like 100 Ways to Increase NOI. But some of the common ones, increasing rents, that's probably the most common one there is. If you look at a property and determine you can up each rent $100 a month, it's a good value add. Additional income sources, we've done all of these. This is a huge one. Adding a laundry facility. Maybe they don't have laundry, and you create one of the rooms in a laundry. Parking, maybe they're not charging for parking. You just said, hey, we're charging $20 a spot now. RUBS, that's ratio utility billing system. We're buying a deal right now where we're implementing that. So, and that's just billing back utilities to tenants. You could add in we've done move-in fees. I mean, there's a whole list of different fees you can tack on. Obviously, you have to do the research to determine if the market's going to support you adding all these fees in there. But get creative. I mean, add different things. Tenant insurance. We've added tenant insurance in some of our properties, and that's another income source. Decreasing expenses, maybe that's your value add, or maybe you're buying a property that's only 80% occupied and you think you can get it to 95%. That's a value add. So it's really the value add strategies are your chance to get creative, but don't get too aggressive with your assumptions either. Okay, so as we go through this, some of you might have seen that the numbers didn't really look too good in this example deal. So really, I mean, you have a few options. You can go back and you could lower the offer price till you get to a point where you feel comfortable with the numbers. Maybe you adjust the syndication split. We did this on our first few deals. Getting into it is we took a lower, if you change your upside on the GP from 30% to 10%, it's going to make the numbers look a lot better. So maybe you do that. You're taking less fees on your first deal just to kind of get the experience and get into it. It's the way to do it. Maybe you change your hold strategy. Maybe you decide, okay, instead of holding for 5 years, I'm gonna hold for 10 years because that'll help the cash flow and the numbers. Maybe just, say, screw this deal, I'm not doing it. In this example, we're gonna go back and adjust the purchase price. So here's kind of, as you can see, they're asked 5.5. I landed at 3.85. It's all, especially apartments right now. I mean, this is a lot of what you're gonna see. A lot of the times I'll still just, tell the broker, this is where my numbers landed. Let me know. 95% of the time, you're never gonna hear back from them on a counter. But you never know. Sometimes the owner decides to come back and take your deal. So it never hurts to throw an LOI out there. An LOI is letter of intent, non-binding. There's nothing that ties you to it. You can throw, a simple Word document LOI together, throw it out there. It never hurts. It also shows brokers that you are a serious buyer. You're not just messing around. Okay, so the return metrics. So once you get all of your numbers locked in, right? So you're going to look at the return. So the most important part is looking at the limited partner returns. It's nice. It's fun to look at kind of what you're going to make on the GP side, but the most important part is what are the limited partners going to make? Because that's what you need to, bring investors in. They want to see good returns. You got to provide good returns. That's the most important part at the end of the day. Giving a good return to your investor is the most important part of doing a syndicated deal. So we're look at that. There's several financial metrics I like to look at to determine, where this deal lies. There's the average cash on cash return. So again, that's, taking the initial equity investment, dividing it by the cash flow. The average just takes, it's going to take the average amount throughout the whole hold period. I like to see that number at least 8%. That's on the low end, ideally double digits is generally where we end up. Average annual return. So that's the average amount investors are going to earn each year. And it encompasses, unlike the average cash on cash, the average annual return encompasses the proceeds from the refinance or sale. So that number is going to be higher because it takes into consideration that equity you're going to get on the exit. I like to set that number at least 17%. Internal rate of return. So definitely the most complicated return metric, but in my opinion, the most useful. There is a whole bunch of, confusing definitions out there you can look up to figure out what it means. But the most basic definition I found is the interest rate at which the net present value of all the cash flow equals zero. So it takes into consideration the time value of money. again, I won't bore with kind of all the details on exactly what it is. Feel free to do some own research on your own to understand internal rate of return. It's a very important metric to look at. I like to see it at least 15%. Again, that encompasses the exit, the proceeds from the exit, and the proceeds from the refi as well. Total return on investment and equity multiple, those are pretty similar. An equity multiple is going to be, if an equity multiple is 2, you put in 100K, an equity multiple of 2, you're going to make 200K. It's a real simple one to look at and kind of explain and see where your numbers end up. Okay, so stress tests. So this is something a lot of people don't look at, but really important too. Before you kind of, you get to that tab and you say, okay, the numbers look good. The last step is to go and look at your stress tests and run some different scenarios to make sure if shit hits the fan, which it's going to, if you're holding a property for 10 years, you'll get lucky and stay in a good market the whole time, but stuff's going to happen. COVID comes up or whatever, interest rates go up and stuff goes down. So a few of them I look at. The most important one, break even occupancy. So the percent of economic occupancy at which the cash flow equals 0. So at what percentage vacancy can you get to and still cover your mortgage payment? That's a very important one to look at. You want to see that number at 75%. I'd say, or even lower ideally, but at the most 75%. And that's going to tell you, the most important part is protecting, the initial, any investment, protecting your initial equity is the most important part about investing, right? So you want to know, where am I going to at least cover my mortgage payment? The last thing you want to do is be coming out of pocket to pay your mortgage. So you got to kind of look at and see, okay, if in this scenario, if 31% of my tenants move out or don't pay rent, I can still cover my mortgage. So, during COVID, we had one property where we had 10 tenants walk in and say, hey, we're not paying rent. You can't evict me. So I was glad, we ran this scenario to see, okay, if we can, we can get all the way down to, I think that deal was like 60% occupancy and still cover our mortgage. So stuff like that happens. You got to be prepared for pullbacks and be able to still cover. Okay. Yep. So that kind of wraps up the diving deep into all these details. Try to get through it pretty quick, but still explain everything. So for me, really, the learning how to underwrite comes down to the education piece of it. Find some way to learn about everything you need to do in underwriting and practice. For me, what I did is I literally I took a model and I went on LoopNet, looked up 50 unit deals or whatever kind of size I was looking at the time. And on LoopNet, you're going to find a lot of the deals have the financials right there on that page. Pull the financials, and just start practicing and determine, okay, what number does this deal make sense? And as you're doing that, you're going to come up with a whole bunch of questions you're asking yourself to figure out, what do I need to be looking at in this underwriting? And that's, I was doing like one a day, just pulling them, practicing, and that'll lead to questions and that'll lead to answers. And that's really the best way to do it. Again, said it a million times, but always stay conservative in your underwriting. That's the most important part. Okay, so going into this year, so generally on these calls, I don't pitch anything or anything, but this kind of just came about. I ended up launching this. So this, and what I'm calling it, the real estate syndication analyzer. So what it is again, like I was saying, I started out where I was, trying to learn underwriting. I was piecing in different education together through, podcasts and books, and I was pulling up different forums, trying to figure out where I can learn this stuff. And I couldn't really find like a centralized place. I just wanted to learn underwriting. There's courses out there that will teach you the whole syndication process or, teach you how to do this and that. For me, I just wanted to learn how to underwrite, and I was just looking for a central place to do it. Couldn't really find anything. So over the past year, I kind of saw that gap and ended up built my own model to analyze deals. Like I was saying, the one all the screenshots were from, built my own model and kind of decided to put together a course that has a deep dive video series of explaining everything you need to know about underwriting deals, templates, and different documents you can use through the processes. So that's kind of how this was born. And then, so this is actually kind of today, I'm officially launching it. Been working on it for a long time. So I'm really excited about it. It's going to include, so I'm also including on this like a mastermind component too. And what I'm going to do for that is I'm setting up 8 calls, and it's, again, this first group I'm doing is going to be relatively small. But I'm setting up about 8 calls. I'm bringing in, I already got a few huge syndicators from the area that are going to come in and speak about how they've gotten to where they are. We're going to bring in bankers to talk about what sort of stuff you need to look at to get financing. We're going to go through and do some practice on analyzing deals and kind of doing screen shares and everything. There's gonna be a ton of stuff. We're gonna go over how to create an investment summary to sell investors on investing in your deal. Gonna do some one-on-one call to kind of give you advice on what specifically your plan might be to get into syndication or to kind of get into these deals. So really excited about it, especially this whole mastermind component. Pricing on it, I mean, I wish I could do it for free, but I got a million things going on, so I got to get paid for it. I'm doing, so I mean, if you want to just buy the model I built and the video series, it's $197. I mean, that's pretty, looking at, there's a few other ones out in the market you can look at, similar pricing. This is actually a little bit lower. And then the advanced option is what I was saying. So that's going to include the model, the video series, and that's going to include this whole mastermind thing I'm doing, which I think where a lot of the value is going to come. So I'm doing that at $497. I mean, that's, you know, you look at some other courses out there, they're charging 20 grand for, you know, probably a little bit more content in it, but it gets pretty expensive, a lot of those other courses. So, I mean, I'm going to be at least doubling, tripling this price on the next round. I'm just doing this as a first round, giving kind of good pricing on this first one. So, already kind of just from today, you know, kind of mentioned to a few people, I've already kind of sold out a decent amount of it. I want to keep this first group relatively small, so I'm able to provide enough value to everyone. It doesn't get too convoluted. So I'm, you know, kind of setting an expected deadline of, you know, this Friday in the next few days, or if it gets, you know, it fills up quicker, I might even close it out sooner than that. So, I mean, if you're interested, you know, this isn't for everyone, you know, it could be too much for some people, but if you're trying to get in this game, I mean, I think this is a relatively low cost way to get to learn about it. I got the page there, howtoanalyzeadeal.com. Feel free to mess with any questions either. Okay, so enough pitching. Questions? Anyone have any questions here? Feel free to shoot them in the chat or Q&A. If you have any questions to ask about anything, syndication, real estate, underwriting, happy to answer anything. Someone asked about if there's going to be a recording. Yes, I am recording this and I will send it out to the list. Okay, I'll give it a sec. No one's asking any questions. All right, no one's got any questions. All right, I guess I covered everything good enough then. Someone asked here, what resource? Okay, here we go. Here's a few. What resource? I'm not exactly sure what you mean by that, Fred. If you want to kind of explain a little more, how do you find experienced partners? That's a good question. Networking. I mean, just go to the local events, Bigger Pockets. That's actually how I connected with my first one. That's a great networking source. And just go out and start telling people what you're trying to do, right? Set goals. For me, it was, I decided I want to get into syndication. I went out and started telling people and found someone else. I was like, hey, yeah, I'm trying to get in syndication too. Let's start talking about it more. That's how partnership again. I mean, it's just really just going out there, telling people what you're doing, what your goals are, getting in the right group, and you'll be surprised how many people you find that are willing to partner with you. You know, looking at whatever market you're in, there's a whole bunch of real estate meetups around the country. Just find a local meetup, hop on webinars. There's a lot of good like webinar networking stuff too to do. Again, Bigger Pockets is a good one too. Let's see, question. What resource do you recommend in the meantime prior to buying? For learning? I think you're referring to prior to buying the course. Yes, I mean, there's, you know, podcasts are great. There's a good amount of them out there. I'm trying to think of a few. There's Rod Cleef has a good one, Michael Blanc, Joe Fairless. I think there's like the Jake and Gino. All those guys are big kind of thought leaders in the group, and they put out some great content in their podcasts. You can find a lot of good info there. Books, I mean, just, Google real estate books. There's a whole bunch of them. You can, I'd say the best one for syndication actually is if you go, there's a book by Joe Fairless. I think it's called Best Ever Real Estate Syndication Advice or something like that. And it's like, it's like an 800-page textbook on syndication. It goes through step by step what you're going to do in each process. That thing it's a lot of information. Not I wouldn't say necessarily a fun read, but that was the best one I've found if you're just specifically trying about syndication. Otherwise, there's multifamily millions. That's a good one. There's a whole bunch of them. Good real estate books out there. Yeah, great book, Peter. Yeah, it's there's a lot in it, but it's very educational. Joe Fairless puts out some good content. He's got a couple billion assets under management. They're huge. Yeah, Rod Cleef's a good one. I think I said Michael Blanc. He's a real analytical guy too. Puts out some good content. Joe Fairless, his podcast is, I think it's maybe straight away a little bit from syndication, but he's got some. Jake and Gino, they're another one. I've gone to all these guys' events. They're really great. Have done a ton of good stuff in the industry. I'd say those are the big ones. I'm also a big fan of Grant Cardone, but he's if you're trying to dive deep into learning real estate, I wouldn't say he's the best resource for it. If you want some motivation, he's pretty good for it. Okay, hey Connor. After you bought your first duplex, did you play around with more small multifamily properties, or did you hop right into underwriting syndication? Yeah. So after I did the duplex, the next deal I did was an 89 unit. So I didn't, like I said, there's a million different paths you can take in it. For me, I knew instantly within a month after buying that duplex, I want to create this into a full-time. I want this to be my full-time job. I don't want to work for anyone else. How can I build this to get there? And thinking about it, was like, I could, not like I'm making a ton of money at my corporate job. I could stash away a little bit of money each year, and I can, buy a duplex, maybe two if in a good year. And I was just kind of thinking about that. It's like, it's going to take me 10, 15 years to get to the point I need to be at to leave my job. So instead, the syndication thing was good for me. It allowed me to scale much quicker and go after larger deals. Again, you're in syndication. You're not like you're owning the whole deal yourself. We have 15 million under management. Not like I own that whole thing myself. It's going to vary by deal and how much equity stake you're taking each deal, but it adds up, the equity in these deals, and then you start getting the appreciation. It adds up pretty quickly once you start the larger the deals you do. What is a good resource to learn cap rates for valuation purposes? That's a good question. Cap rates, if you're talking about trying to predict where cap rates are going to go in the future, you can dive into some, cap rates are really based off of interest rates. That's really cap rates for the most part. If you look back historically, they're based off of where interest rates are. So if interest rates go up, cap rates should go up. If interest rates go down, cap rates should go down. So interest rates are record lows right now. Cap rates are record lows. They're talking, Jerome's talking, he's going to be increasing interest rates here in the next year. I'm hoping cap rates correlate and go up with interest rates. You never know. But as far as a good resource to learn, cap rates for evaluating, I think just general, studying the economy is probably the best way to analyze that. But once you kind of understanding the actual underlying components of a cap rate and kind of the financial metrics of it, that's pretty simple. You're just going to understand the formula of it. Also, if you're trying to figure out what cap rates are industry average, once you start looking at more deals, you'll know, an A-class deal trades at X, a B-class deal trades here. This area of town is going to get higher cap rates than this one. I think that just kind of a lot comes with just, experience. There's also a ton of good reports. If you go to a lot of the big brokers like Marcus and Millichap and CBRE, go on their website and subscribe to they do those guys send out reports like every week. And they do like quarterly analysis of each market and what cap rates for which asset class landed where. And they do a whole bunch of deep analysis on cap rates. So that's a good resource if you're trying to kind of establish what are market cap rates for a B-class apartment and, a suburb of Milwaukee, stuff like that. going into those reports is a good resource. Any other questions?